Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
All right, we are back here on the Investor Coaching Show. Paul Winkler along with Evan Barnard. So, Evan, you didn't get a chance to comment on anything that I just went through. And I'm dying to hear comments regarding.
Yeah,
so those of you that are just joining, the whole idea is there was an article in Popular Mechanics, veins of gold being found after tectonic activity increasing in various parts of the world. And the idea with quartz and tectonic activity, that gold all of a sudden, shows up. If you start to increase the supply of gold, you can drive down its value. And how do gold nuggets actually? That was in so two totally separate publications, National Geographic and Popular Mechanics, both saying basically the same thing. So anyway, thoughts?
Yeah, a couple of things. One, just, we're in the Christmas season anyway. And so, kind of like when Bitcoin first hit the scene. And so everybody's going out buying a computer and they're trying to, mine Bitcoin. And of course, then that took off. And so I can now picture people like going out and getting a power plate and a big slab of quartz.
There you go.
That's my Christmas thing. But then I'm picturing, okay, well, if we now have, lab-grown diamonds.
Yeah, right. Oh, yes, exactly.
And so now if we have lab-grown gold,
you can
just make it in your garage. And, I was just saying, I picture this, poor guy going to propose to his wife. And, I've got this nice lab-grown diamond with this lab-grown gold ring. And she's like, what?
Right.
Get out of here.
We're gonna give you what would take the place? It's funny because that is a real deal. I mean, it was who would have thunk that you were able to actually create diamonds in a lab.
Yeah.
And I made the joke during the break that it was fake diamonds. You go, no, they're real. They're just lab grown. And, so that I just thought was just interesting stuff.
Yeah.
And, just keep in mind, really, people say, in seriousness, one of the things that people often say is, when it comes to investing, that they like real estate, right? Mm-hmm. And why did they say they like real estate, Evan? Because
they're not making any more of it.
That's right. They're not making any more of it. And, that's what makes it valuable. Now, you can expand and you can expand cities. Now, you can make a case, and I've made this case before, that let's say that transportation becomes much easier in the future. And let's say that living within proximity of the city is something that's important because you need to live where there are other people and you live near where your work is. Mm-hmm. And you don't want to live, let's say, 20 miles outside the city, and because of traffic, it takes you an hour and a half to get there.
Right.
But all of a sudden now, the way you get to work is you fly there, and you can fly there in 15 minutes and live, 30 miles outside the city.
Yes.
Then all of a sudden, now you got something here because you own this piece of property much further out, and it's a lot cheaper. Mm-hmm. And, you could actually see the value of land in the city go down because people don't need to live that close anymore.
Right.
You can live outside and it's just fine. So that's why land becomes valuable, because they're not making any more of it. And I'll often retort, I'll come back with, well, I like owning, companies because they're not making any more Microsoft. They're not making any more Home Depot. They're not making any more, name company, whatever. They're not making any more of it. It's the scarcity that makes something valuable. And if a company makes something that is very unique, that makes them scarce, that's where the value comes from. And just keep that in mind, because it's really important to understand that concept of investing. And too often what happens is people see something, recency bias is what we call it in psychology. Mm-hmm. They see something go up in value in recent history, and then they jump on board thinking, wow, this is the next thing. This is what we ought to be doing. This is what I would invest in. This has, great value. And they believe that it has gone up. It's going to continue to go up. And that's what I was joking about earlier. I made the comment. I says, what do you call a 30% decrease in the value of of Bitcoin. And I jokingly said it's a good start. Who knows what it's going to do? We don't know. But that's the problem. We don't know what it's going to do. We know that its value is based on supply and demand, but it's also based on tastes. It's based on people thinking that it's worth something. I talked about the dollar in general, the fiat currency of the dollar. And I talked about, years ago, I brought this up, but it was an article in the Wall Street Journal about these shipmen in South Africa, and they would go out to the ocean and they would come back to get their pay, and they would run. They had a foot race to the pay office, is basically what the Wall Street Journal pointed out. They would have this foot race back there, and you go, well, why are they racing back to get their pay? And the reason was because they would actually stack $20 US dollar bills at the pay office, and they would pay these people in cash. And the way they would actually set it up was that the dollar bills, the $20 bills that had been printed or minted most recently, were at the top of the stack. And as you went down the stack, the date on the $20 bill would be earlier. So you might have a 2025 $20 bill at the top, and you might have a $2009 bill, somewhere in the middle, and you have a $2020 bill at the toward the bottom of the stack. Well, the ones that were worth more were at the top of the stack. The ones that were more recently printed were at the top of the stack. And the Wall Street Journal was making the point that the reason that the dollar has value is because we all have this belief that it has value.
Right. It's an agreement.
Yeah.
It's a conversation.
That's it. That's exactly right. And you think, whoa, that's a little precarious if you think about it in a way.
Yeah.
And, why do, whatever it is that we believe that has value, back in the day, it might be exchanging eggs for, for bread or whatever, in the old economy. And it was because we both had this belief that this thing was worth something, so.
Yeah.
It is an interesting thing. I mean, there was this article, as a matter of fact, to talk about NVIDIA saved the market until Bitcoin broke it. And there was, I don't know if you saw that article, but it was in Advisorpedia. It was where it was. And this guy is sitting down to dinner with his friends. And he was talking about how, how the correlation of, of Bitcoin and NVIDIA. And what ended up happening was that when Bitcoin go down, NVIDIA, and I did this in a recent workshop, I was teaching to a group of ladies, and it was a sharp group of ladies. This group was a book club, and their backgrounds were super, super interesting. One of the ladies was walking me out, and she says, "Oh yeah," she goes, "I'll date myself right now. I worked on the NASA program, the Apollo program, computers," and I was. Whoa.
Yeah.
So these ladies, it was a super impressive group. And the conversation that we had was about Bitcoin. And none of them trusted it. That was one of the things that they had me come to speak to the group about. Okay. So what I did is I drifted into other areas because I knew it wouldn't take me long to finish that conversation. But, they didn't trust it as far as they could throw it. And we got into what the problems were. And they said, this just makes so much sense. But one of the charts that I showed in the course of this workshop, so to speak, that I was teaching, was a chart of the stock market and Bitcoin. And the correlation was uncanny. It was high. They both moved together up and down. I forgot what period of time that I actually had on the chart, but it was showing that they were just basically moving in lockstep with each other. And it was the whole idea was that these things are supposed to be non-correlated. Anyway, we'll be back right after this. Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement. Real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. what's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. Interesting little piece in CNBC talking about Roth conversions could trigger a tax torpedo under Trump's new tax law. And, so this is one of those reasons you got to be careful about this. A lot of times we get these, financial firms that are really, really pushing Roths and saying, and it's not a bad thing. We believe in it ourselves. But we're super, super careful, because I've seen a lot of times that the advice is not terribly careful. And that's the problems that I run into, as I've seen people where they've gotten proposals to convert large sums of IRA money to Roth IRA money in the idea that tax rates were definitely going to be higher in the future. And it was just a misunderstanding of the marginal rate nature of our tax code. And how, if we look at the last dollars that you earn, they're taxed at a higher rate than the first dollars that you earn. But in essence, in here, they were talking about the tax torpedo, or that you could have an artificially higher rate due to phase outs and benefit reductions. And this is something you have to be super, super careful about. But I just want to put this out there to understand it a little bit. When I put money into an IRA, and I am in a 22% tax bracket, let's say. I put a $10,000, let's say I put it in a 401k, and I put $10,000 in there, and forget that you get matches and those type of things. Let's say if you get matches in your 401k, let's forget that for a second. If I put $10,000 in there, I save $2,200 in taxes on that contribution. Now that $10,000, let's say that it does whatever it does, but let's say in this case just that it doesn't grow at all, just to keep it really super, super simple. And I pull the $10,000 out in the future, and I'm in a 10% tax bracket. Then I saved $2,200 when I put it in. I paid $1,000 when I pull it back out. And that is tax leverage, the idea that I end up in a lower bracket in the future. Now, that will be that is magnified to some extent if we have, let's say that we have growth in the investment, then it's going to be a different deal. But I just want you to get that idea behind it. Now, what happens when we go and pull this money out and pay taxes on it right now, especially in retirement, we may have tax torpedoes in that Social Security. You can trigger Social Security taxation. If you're in a state with a state income tax, it's one of the things they talk about, the SALT tax.
Yeah.
The idea that, there are phase outs with the SALT taxes. You could have issues with, they didn't mention this in the article, but IRMA, you could have some issues right there. You could have, and these aren't new with, Trump. I think it was an article just picking on Trump.
And you could end
up
losing that extra $6,000 or $12,000 quote unquote standard deduction.
That's exactly right.
If you trigger over a income level.
Yep. No, that's exactly right. Now, they said some things in there, child tax credits, student loan interest deduction, if you got, they threw those in there, education tax breaks and those types of things. But in general, it's not just simple math that you look at what's your marginal bracket versus what's your bracket when you pull the money back out. You have to look at other things that you might lose. And I think that was a point well made in the article, that you have to really be conscious of this. So a lot of times what we're doing is there's sophisticated software programs. We're talking really programs that are crunching numbers at a high level and taking everything into account to determine a schedule for converting. Does it make sense for some people to convert to Roth IRAs in retirement? Absolutely, it can. But be super, super careful when somebody is just having you do a large sum of money, or they're not really using. I recommend making sure that the advisor is using some really sophisticated programs to actually help determine whether it makes sense to actually make these conversions from IRAs to Roth IRAs. And it's just simply because it's so complicated. There's so many moving parts that I just wanted to bring up this particular point in here. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.